If the economy is so strong, then why are the markets freaking out? Let me ask you that. What we're looking at today is truly a circumstance that is not necessarily never happened before, but I couldn't help but notice the similarities to 2007. In fact, there are many indicators right now that are flashing red, and we're going to talk about that today. One of the aspects here is that stocks are still near an all-time high. Yes, they have come down. We see a lot of red recently, but it's not necessarily one in which everybody is freaking out. However, certain indicators are starting to flash, and we've got to pay attention. I'll tell you why. If you look at it, the bond market, the message from it has been very clear. The Fed is tightening, and that hurts. So that has shown up recently, as well as the fact that the markets and businesses can now only persist with ultra low rates. And as you see, we've been going on here over the past year in an increasing rate environment longer than we ever predicted it would be going for. At least that's what the investors thought. And here we are. Here we have it. It is causing havoc. And so now we have to see what is all in front of us. I will show you the details you need to know, beginning with extreme fear returning to the US stock market. It's very funny how this works. The fear and greed index, there's many different variations of this. But when I see the fear and greed index, I think it's funny because the fear comes in almost instantly, like 2 days of fear, and we go all the way to one side. But the extreme greed, it takes a lot longer. It takes like weeks and weeks and weeks and weeks of this go on. It's funny how slanted it really is. All you need to know from that is that these markets right now are a little bit fearful. They're a little bit oversold. And why is that the case? Well, of course, we're seeing many factors come into play. Higher oil prices, as I'll show you in a second, and other things really going towards a recession and so on. So that being said, we need to factor in how relevant is this for you? Like, should you even care? Well, if the market's going to go higher and jobs are still going to be there, then no, you shouldn't. But there's a cause for concern. We'll talk about that. Here we have it. Oil prices finish at the highest levels in a year, inching closer and closer to $100 a barrel. If they get too high, then that slows the economy down considerably. Some people are saying 150 is very obvious. JP Morgan has said that. Other big banks, other high profile people have come in and said $150 a barrel seems rather likely. Now, usually that's the way it works. When something is in a bull market, they just keep putting higher and higher price targets, but it is possible. It all depends on China as well as the rest of the world. If China is going to slow down, that would bring everything down along with it. There's more to that, of course. US Treasury yield curves are moving towards or above 5%, raising the risk something may break. This is very confusing for some people, I know, and you could see it for yourself when we are getting these high rates of returns. Yes, that poses a problem. It poses it simply because a lot of these banks, as they mentioned in this article, like SVB, they had really run into a problem. You see, they are long duration, and that means, they're trying to get into, they got to have a return for their customers, okay? If you're a customer with SVB, or maybe it's JP Morgan Chase or TD or whatever it is, you have to get some sort of return. Now, if they want to keep you as a customer, they're going to have to give you higher rates. How do they get that? Well, they have to invest in something that is giving them a higher return. And so they can certainly loan that out to you as a customer. They can figure these different things. But what have we noticed over the past few years, or the past year at least, is that deposits are flowing out of these banks. And so they're panicking, trying to offer higher rates. At the same time, they were investing in things that were not yielding very good for a long time. Like, you were getting these 30-year bonds and 10-year bonds and all of these things that the banks would consider safe. They had very little yield. They had very little return. So they're holding on to that. So now that the rates have climbed up considerably, they're losing. They've lost on that investment. And so how are they going to go and sell that investment without taking a big loss? Of course, they can't. And they realize this. That's why you had SVB. That's why you got all these problems. And so we have people like Michael Gayed, who has come out saying, it has begun. We are in the credit event, suggesting that this is the time in which a major deflation will occur. He's put his name behind that. We'll see what happens. He's only one individual, of course. You know how it works. But it leads me to this. This is from Real Investment Advice. And here we have it, the Fed funds rate and crisis. And you could see, it's a matter of fact. Every single time the Federal Reserve increases interest rates, we have a problem. We have a recession. We have a crisis. We have an issue that is then resolved by cutting interest rates. And you have to understand this. This pattern happens over and over and over and over again. You don't need to be a genius. You don't need to be a soothsayer. You don't need anything. You simply need to look and understand that eventually at some point, something snaps. And when that does happen, well, depending on where it breaks first, we have a chain of events that follows. But that's going on right now. And that really is the center of all of this. The Federal Reserve is increasing rates. It's causing problems in the bond market. Number one, because it's happening so fast, but also markets, investors, businesses, they've all been programmed that interest rates are going to stay low forever. We were told that. We were even told that inflation will be transitory. Can you believe that? How stupid was that? People believed it. A lot of investors believe it. The YouTubers kept saying it. It's nonsense. But that's where we're at. Okay? So we have this. And I need you to be aware of that because they have yet to cut interest rates. At some point they will. And when they do, they are going to create massive inflation. It's going to be devastating. We're just waiting for it to happen. There are things you can do, actions you could take that you must be aware of. We'll talk about that at the end of today's video. What's next, you may ask? We're going to look at that, and a lot of the circumstances have already unfolded, and they're not positive. Of course, I talk about it all the time, central bank digital currency, where they're going with this, the basic cashless society, and so on. If you want to get your hands on some financial advice, if you want somebody to be there to talk to, and you want it to be free, I linked up with this company right here, and it's Money Pickle. Yes, that's the name, Money Pickle. You can check it out. I got the link in the description for you. And basically what this is CFPs and fiduciaries ready and willing to help you for 45 minutes for free. And you do what you want in that 45 minutes. They answer any questions. Why not? Take the offer. Totally free. Link is in the description. Here we have Buenos Aires Central Square becomes a nighttime soup kitchen as poverty hits 40%. Quite unbelievable to see that. I mean, it's gotten worse than even I expected it this fast. But that's the way that inflation works. It's parabolic. It gets worse and worse and worse and worse and worse and crushes people. So we've got to pay attention to inflation now before it gets too bad. Costco is selling gold bars, and they are selling out within a few hours. First of all, usually Costco you buy in bulk over there. I don't know if you're buying in bulk for the gold bars too. But here we have it. You can see it for yourself with this one particular instance of people taking action. They're saying, I'm going to go to Costco. I'm going to buy the gold. I'm going to buy gold because I want to protect my wealth against inflation. 60% of Americans are still living paycheck to paycheck as inflation hits workers' wages. I had to check the date on this because I could have sworn I've mentioned this 100 times before. It's always the same. 60%, 70%, all these numbers. Most people are living paycheck to paycheck. Is it just, the people that are really struggling on minimum wage that are living paycheck to paycheck? No. It's anybody. You go 250 all the way down. People are struggling. Well, maybe you could argue that that's because they don't have the right mindset or they spend too much money or this and that. Sure, that could absolutely play a role. But in a lot of cases, things are just much, much more expensive than they were before. Where that salary, let's say the house price would have been 30% of the total salary, the rent would have been 30%, then it jumps up, it becomes 60%. when your food and your energy and everything else, suddenly that puts a big squeeze on you. It happens so fast. I know, I've seen your comments before. How many times, how many times are we going to encounter this before we start realizing this is adding up? Pardon my voice here today. Major retail CEOs warn of dire shoplifting epidemic after $112 billion in losses, causing chains to take drastic measures. And we've seen this all over the place. You can look at this one by one by one. It's not just Philadelphia, as you see in this case here, but it is shocking. So let me tell you some of the actions you can take. Stocks which have no present value are at high risk. Okay, you got to understand this. If the company's business model relies on some future payment, some future investors, some future idea, these are not the companies to be investing in right now. Yes, you can dabble in that, you can gamble in that, but you don't want to put life savings in there. Understand that. Know what their business model is. At the same time, it looks more likely that banks are in trouble. So watch your exposure. Yeah, you might not be invested in banks, but what about where your deposits are? What about when one bank is with another, the counterparty risk? You got insurance companies. Like all these things are connected, and as well as you, the individual, watch your exposure overall to these banks. It's a very big concern. Okay, I'm not so concerned about the deposits because it looks like the Federal Reserve is going to print a whole bunch of money and give it out. Just watch your exposure. Those are the things that you need to take action on today. Okay, those two things. Watch those. I also wanted to let you know that with Compass, you're going to be able to start your financial journey. It's very clear to me that most people don't have the basic financial education. And so right here, your financial journey starts here. That is Compass, themoneygps.com. Themoneygps.com is totally free. Why not? Check it out, themoneygps.com. And then we have this. David, I just checked out this is the comment of the day. And of course, it was a plug, so I had to mention it. Thank you for the comment. I just checked out Compass and it is really great. At first, I thought the multiple 1-minute videos were too much, but then each one is distilled into the essence of years of experience and hard lessons learned. Thank you for doing what you do, and even more respect that you don't even have a paywall. Yes, that's right. There is no paywall on that. There is no email needed. There's no ads. There's no nothing. It's totally there for free. TheMoneyGPS.com. I want to thank you for being here today. Thank you for putting up with my voice. I appreciate you. If you appreciate me, hit that thumbs up button. Each and every day, I bring you the latest and greatest information. I'll talk to you next time. Take care.